Hello, everyone. I hope you're all good.
Hello, Professor.
Okay, just before starting the new chapter, I would like to just remind you that on Friday we're going to have the quiz number 3. It's going to be, I just added the third quiz with the purpose to make you to get the best 2 quizzes out of 3 quizzes. Just wanted to remind you. And concerning the chapter, this is the credit risk chapter. We're going to start. If you have any questions, any comment that you want to make, please go ahead now. If not, I will start now. Okay. This chapter is about the credit risk and basically related to individual loan risk. So this chapter will discuss the types of loans and analysis and the measurements that is conducted in order to avoid the credit risk, not the avoiding. Again, we cannot avoid fully the credit risk. Any type of risk cannot be avoided, but it could be reduced to a certain level. So we'll discuss different types of loans that the banks or financial institutions they provide, and what analysis, technical and fundamental, are used in order to measure the credit riskiness of loans that we provide as a financial institution. The important for purpose of pricing loans and the bonds, you already know how the loans are priced and how they give the price on the loans, and there will be setting on the limits on the credit risk exposure. So there are some weaknesses of the technical analysis, mathematical analysis that has been conducted, which was developed by certain scholars, and they have got some weaknesses, some limitations, and we will discuss them as well. Okay, talking about in 1990s, okay, especially in the United States, because the book and the course is more based on the financial institution management of the US. So in 1990s, the bonds and the debts, they had some issues, okay, especially the credit cards and auto loans. They faced some problems, like when they used to provide this type of loans, they actually, at the end of the day, they became bad loans. And the same thing happened with the bonds. It was it was a good bond, and then at the end of the day, they became a junk bond. Junk bond, it's a speculative bond, which is less preferable. The probability of default of this type of bonds is high. And on the other side, if it's been a junk bond, on the other side, it becomes like more, in terms of return, it gives you more return due to the risk that it has been taken for the investors. And in 1990s, in some countries, in 2000 even, it was the case that the credit quality problems triggered some crisis. The crisis in Argentina, Brazil, Russia, and South Korea. And in 2006, 2007, subprime mortgages or subprime loans, they have triggered out the big global financial crisis that affected all of the countries of the world. So there was no country who was just not being affected due to this. So everything comes, the idea that everything just comes from the credit quality problems, and the idea the banks, they provide the loans, and that loan becomes the bad loan. When the bad loan is not paid, and this not payment of the loan that doesn't come the money into the bank, and the bank was expecting to receive this money to pay other demand withdrawals or to pay other expenses they could have met in the future, and they are not able to do so, or they were not able to provide a loan commitment. Like, everything is interconnected to each other. If the bad loans are not really, if the good loan becomes the bad loans and the loans are not paid, there is a default on the buyers, the bank doesn't receive the money. If the bank does not receive the money, the bank does not provide any additional loan commitment. Can be the place like the corporation when they sign an agreement with the banks in order to get the loan commitment. So that results actually with the liquidity problem of the bank, and any enterprises in the industry. So bad loans brings really bad consequences to the economy as a whole. So in 2006, 2007, the mortgage subprime loans, and how the loans become the bad loans is due to the credit quality measurement, okay? The monitoring, the screening out the probability of the repayment, the debt back of the potential borrower. If it's not performed well, if it's not conducted well by the financial institution, the screening and the monitoring the borrower, then the result will be really terrible. That happened in 2006, 2007 global financial crisis, when the loans were given to the potential borrowers without any proof of the financial history, without any proof of the salary slip or anything else like. You just need to have your identity card. Even if you are just student, you can get easily the loan, because it was really something strange in these things. I mean, everybody was given the loan, and those clerks that worked in the banks, when they used to provide the loans, they used to get some bonuses. The more loan they give, the more bonuses they get. So at the end of the day, they are ending up with the more money. So that made them to work harder to find more and more potential borrowers, even without considering their financial history. So at the end of the day, they end up with the default of those potential borrowers they have provided the loan to. For credit ratings, you can visit the following websites like Moody's and Standard Poor's. You can see that some banks are rated, not some banks, all of the banks are rated by Standard Poor's and Moody's. There are other credit, Fitch rating, and there are other rating systems that rate. Sometimes it can be governmental, these are privately owned and independent companies that they rate the financial institutions for credibility. So over the year, early to 1990s, the improvement in non-performing loans for large banks and overall credit quality. So once the bad loans started to come, the central bank started to think about how to take everything under control, like Fed, that time was the Fed and this time as well. So they just tried to control and to make sure that the banks, the commercial banks or conventional banks, they provide the loans, they should do it with the regular way and with the controlling the ability of the borrower to pay back the loan. So giving some quality for the borrowers, like not giving the loans to everybody who just a citizen of that country. In 1990s, at the late and the earliest of 2000, there was a telecom companies, mostly like telecom companies went bankrupt. It was dot-com crisis in 2000s. So, and of course, these companies, like telecom companies, there are many telecom companies, they borrowed money to finance their future projects. Unfortunately, once they went bankrupt, they were not able to pay the debt. So that made the good loans to be bad loans, actually, for the banks. And eventually it affected the whole economy. And after that, after some while passed in 2000s, the economic growth, the economy started to grow. And this economic growth was accompanied by reduction in non-performing loans, because if economy grows, everyone is making money. And during this period, it is very rare that to happen that the companies will be defaulted on their payment. And of course, it was for some period, and at the end of the day, like for after 5-6 years, this happened again, like mortgage crisis that we talked about, 2006, 2007 global financial crisis. And after the mortgage crisis, after 2011, we can say, now the banks are more attentive and they're more serious in terms of credit risk evaluation. They use different tools, different tactics, and different instruments in order to evaluate the credibility or creditworthiness of the borrower, whether to accept the loan or not. For example, in Kazakhstan, if you apply for any loan, like in Halyk Bank or Kaspi Bank, they ask some certain level, some certain questions. And for as a financial manager, like providing the loan, what would be your first question to ask as a bank, as a potential borrower? What do you think? What question would you ask?
Do you have a stable job, maybe?
Yes. So you will ask to provide a proof. For example, in here, it's very good, stable job. Do you think that if the borrower will tell you, yes, I have the stable job, will you believe this?
No.
So by word, the word doesn't mean anything. So you have to support by some certain official documents. And in here in Kazakhstan and in Turkey as well, what they do in order to find whether the person is using the stable job or not, like they're using their like contribution of pension funds, like how frequently this guy was contributing the pension funds or the company that he is working. Like if he is working for last 5 years, okay, last 5 years, or in here in Kazakhstan, in order to get the loan in any bank, it could be any bank, your contribution of the pension fund should be at least 6 months. 6 months, okay? Then you are eligible to apply for a loan. So you have a chance to get the loan. So they see that at least for last 6 months you have been working and you have been contributing to the pension fund. So this proof, one. Second, so they ask official paper from the pension fund organization in Kazakhstan. You have to bring it like at least for 6 months contribution of the pension fund. Second thing, in order to prove that you have a stable job for the last 6 months, you have to, or for the last 5 years, you have to bring actually the kind of salary slip or a paper, employment paper that officially declares that you're officially hired and you have been working since, I don't know, since 2000 up to this date. So official paper of employment. And the third thing that in here they ask regularly, and in Turkey as well, and in Cyprus, as I remember, they do require from you something else as well, like if you had previously borrowed any money, okay, previous credit history, like how you were successful in payment. So, and this is just the beginning. And the requirement of the documents, the quantity of the document that are required to supply to get the loan, it depends on the amount of the loan that you are applying for. So after the mortgage crisis, after the 2006, 2007 global financial crisis, that all the banks, they took the lesson, they started to implement this monitoring and the screening of the borrower creditworthiness. Otherwise, what happened in previously, they didn't even care about these documents. They just gave it directly. If you want to get the loan, just get it. You want to get the loan, just get it. However, if you're going to be this much strict, and requiring many documents, okay, thousands of the documents, and passing it through different process of the bureaucracy system, believe me, it's going to affect the competition. So that will actually reduce the market share. Maybe do you know anyone where you can get easily the loan nowadays? Which bank? Halyk Bank or Kaspi Bank?
Kaspi.
Kaspi, easy. Yes, there's some, like, the money is not big. Let's say, as I know, there's a Kaspi Red. Okay. They give you, I'm not advertising Kaspi or something, okay? I'm just giving you the example. They say that you can pay, you can get the credit card for 150K, okay? you can get 150K. So that makes this is the one of the tools which is used by Kaspi in order to attract more customers. Were they successful? I don't know. Maybe they were successful in this. They attract a lot of customers, and now everybody is using this credit card. But to do the same thing in the other banks like Eurasian Bank or Halyk Bank or other banks, it's a bit difficult. Like it needs to pass some process. So in this way, they are losing the customer. So it was in the previous. However, this year I received a call from Halyk Bank. They told me, you are being a customer. Now you can apply. You can apply for a loan up to 7 million online. So I don't have to come and sign anything. I can apply and get this up to 7 million, like credit line, like revolving loan. We call it another way, it's a revolving loan. The loan that can be up to some time and up to some amount. I can take it at any time I want. Like it can be weekend, I can be abroad, so I don't have to come and present myself to the office, to the clerk and apply there. So they make this financial product. So this is the kind of financial product. So they kind of competing with each other, trying to make more attractive and more attractive. And I'm sure it's gonna go further. You will see you'll get more benefits. On the other side, I realized that I just checked out Eurasian Bank. Okay, Eurasian Bank. They have provided to everybody with a credit card of 50,000 tenge, okay? If you use it, let's say for 3 months, I think you can increase it to 100. Then after 3 months again, you can increase to 150. So it's again, you don't have to work actually, you can get this credit card directly. So if they don't use this financial product, and it seems that they are competing each other and they are trying to offer the similar product, but with the better condition and with the better services. And it goes like this, okay? It doesn't end. I mean, actually, when there is a competition, it really increases the quality of the product and it really improves the standard of living of the people. If there was no competition, it was very difficult to get certain product. For example, I remember the time when the computers and they started just to develop in 2004 in Kazakhstan. In 2004, one flash USB or flash memory, okay? For how much I can buy now? 30 gigabyte, okay? One flash memory. Or nowadays I can see there's 64, 128, 64 gigabyte. For how much money I can buy it nowadays?
I think for laptops is very cheap.
They're cheap, very cheap, 10 bucks, okay? They're nowadays 10 bucks. You can find it easily for 10 bucks, 4,000, 5,000 tenge. If you search it well, you can easily find. But in 2004, so you can find it anywhere. Even if you go to the grocery shop, you can find the flash memories there. Even you can go to the bazaar when their vegetables and fruits are being sold, you can find it even there. So it's everywhere. So the competition in technology has increased much dramatically. But in 2004, to buy one flash memory, I bought, I remember one, which was 256 megabits, okay? Not gigabyte, but megabits, okay? I paid $100. It was unbelievable. Now I'm trying to remember, like I paid 100 bucks to buy this. Now for 100 bucks, I can buy really a mobile or with the flash memory even greater than much better, like 64 gigabyte or something else. So that competition in any industry, it really makes the products in a good quality and it contributes a lot to the development of the economy, and it improves the quality of standard of living of the people. If there is no competition, that really makes the things bad. This is non-performing asset ratio for the US of the commercial banks, like of total real estate, commercial and industrial loans, loans to individual, and all other loans, as you can see. The most popular in 2009, 2007 was the real estate loans, the most popular one. And then, as we can see, in 2000, commercial loans as well. And the loan individuals was popular in 90s, and we can see that all other types of loans were like more stable. The most popular became was in 1990s, the real estate, and the popularity just went down and it again increased commercial loans. So the loans in here are the bad loans, okay, not the good loans. So the more loans are provided, so as you can see in 2007, 2006, it increased dramatically, the bad loans. Why? Because the people, they started to default, because everybody was able to get the loans, everybody, especially the mortgage loans, and they were not backed with the collateral. Okay, there are some commercial and industrial loans, okay? The commercial industrial loans, actually, CI is the abbreviated form. They can be secured, they can be unsecured, okay? As the name suggests, it can be secured with the really better monitoring and screening out the potential borrower, or it can be unsecured. And in the most case, commercial and industrial loans are syndicated loans, which means that these loans are gathered by many institutions and they provide all together to certain industry, manufacturing industry, the airline industry, technology, IT industry, and so on. So there's no, like, more than one financial institution, they come all together, they create a syndication, and they provide the loan, and that loan is called syndicated loan. Basically, this commercial industrial loan, they last from few weeks to 8 years. Those loans that are given for few weeks, they mostly used for firms working capital management or like to finance short-term funding. And those loans that are used for more than 1 year, like up to 8 years, they basically, the companies or corporations, they use it to purchase real assets like machinery, finance their credit needs, or like refinancing or rescheduling the payment of the debt, to buy, to acquire, like merger and acquisition, the new venture startups, and so on. And the amount of the commercial industrial loans, it changes from $100,000 to 100 million. So as I told you, secured and unsecured loans, as the name suggests, the loans that are not well monitored or screened out, they're all unsecured. And secured loans are literally, they may be backed up by some assets, they might be backed up by some collaterals. Okay. So spot loans and the loan commitment. Spot loans, the loan that is given once, and loan commitment, you already know it. The loan, it's a credit line of the loan, like it's within the period of time, within a certain period of time, you are given a loan, and that loan will be taken down by the borrower at any time he wants within the specified time, and and it should not pass a certain amount of the money. And in some period, like from 1990s and in 2000s, there was a decline in commercial and industrial loans, which was originated by the commercial banks and the growth. And this was due to the growth of the commercial paper. Okay. So what was the difference between the providing the commercial and industrial loans and just using the commercial paper? Imagine we all now, for example, nowadays, if you want to go and borrow the money, what is your step? What you will do? Where will you go?
To the bank.
To the bank, to the financial institution. But in United States, in Europe, in developed countries, there's nowadays most of the people and most of the borrowers, they go to the financial market. They issue a commercial paper for 1 year, for 6 months. It can be corporation, it can be any other companies. They issue the commercial paper because the interest rate they pay is much, much less than in commercial and industrial loans. So this actually motivated all potential borrowers to move from the commercial industrial loans originated by commercial banks market to the commercial paper market. So there was a huge growth in the commercial paper. And the most famous issuers of this commercial paper were Ford, General Motors, and Tyco. Okay, these companies, they were most famous and the largest corporations in the United States. And at the end of the day, what happened? The economy slowed down. And if you want to compare, if I remember correctly, for the United States, the circulation of the commercial and industrial loan from this commercial bank was actually almost 1.5 billion. Okay, almost 1.5 billion. 1.5 billion. Oh no, sorry, trillion. 1.5 trillion. I'm very sorry. 1.5 trillion using the commercial loans. But then once it was very popular and it was very cheap to finance their projects through the issuing the commercial paper, the issuer of the commercial paper reached 1.90 trillion. So it was much, much higher than the loan. And of course, in 2000s, the economy slowed down due to the dot-com crisis. The economy was slowed down, and that slowdown made actually the commercial paper to increase in terms of not repayment back. Okay, those issuers. Okay, who are the issuers? Like when Ford they issue the commercial paper, that means the Ford is borrowing the money from the financial market. So they promise they're gonna pay back the commercial paper value that is mentioned in the commercial paper. They're gonna pay back. But if they don't pay back, it is called a default on the commercial paper. It's not a non-performing loans, but it's non-current loans. Non-current loans, okay? It's a non-current loans. It's a non-current loans. So it's kind of bad loans as well. It increased from 14 to 24 billion. And due to the default of the repayment, and mostly was Ford and General Motors and Tyco, the grading system for these companies was downgraded down. And it was like from tier 1, tier 2, tier 3. Okay, there are 3 different tiers. Tier 1 was the best one. Tier 2 is more or less in the middle. Tier 3 is that's it. I mean, it's at the bottom. So that Ford and the General Motors, they downgraded from tier 1 to tier 2, but Tyco, they downgraded from tier 1 to tier 3. So they gave up actually commercial paper market by moving to the bank loan market at the end of the day, because in the commercial paper market, it was very difficult for them to get the loan because they were downgraded. Real estate loans and like primarily mortgages, it has been divided to fixed rate and adjusted rate mortgages. Mortgages can be subject to default risk as well when the loan to value increases. Like, for example, when you buy a flat, okay, when you buy a flat, that flat costs you 100,000. Okay, that's okay. And you went for the bank, you said, I want to borrow 80,000, or let me make it 80,000, which means that you've got 20,000 already down payment there. So the banks give you the 80,000 plus charges you 10,000 of interest. So the total value becomes 90,000 of the loan. And the banks, they know that the value of the house will be increasing every year, let's say by 20%. So next year it's going to be 120,000. This is the expectation of the bankers. This is the expectation of the financial institution. However, when the time comes that loan to value rises, that means the loan becomes higher, which means that the value of the house, instead of increasing, it goes downward, like it becomes 80,000. But the value of the loan is 90,000 nowadays. So the loan is more than the value of the house. So the mortgage is, this case, is subject to the default risk. And of course, in this case, the risk premium should be increased. However, when you sign the contract, when it's a fixed rate, then it really makes the things more difficult to you. It's really tough to change, and you incur the losses if the interest changes and the value change of the house. But the best thing in the favor of the bankers and the financial institution, if you use adjusted rate mortgages, where you will adjust your rate in accordance with that. When the interest rate changes and when the value of the house changes, you will do accordingly in order to compensate the loss that you had. But nowadays it's very difficult for the for the borrowers to go and agree with the adjusted. If you do so, maybe you have missed some contracts and so on. I mean, it's not logical to be on the safe side for the borrower. They will get benefit if they go with the fixed rate, but the banks and the financial institution, they will be in favor if they apply adjusted rate mortgages. And this is how it was developing and changing, the adjusted rate mortgage share of total loans closed. As you can see, it was very popular in the previous years, in 1990s, but up to this day, like 2011, it became less popular and less demanded. Or 30 fixed year mortgage rate, as you can see. It was very popular as well, but they kind of go in line. So apart from the commercial industrial loans, the banks, they provide individual loans like personal, auto, credit cards, and so on. This individual loan can be divided into revolving and non-revolving loans. Non-revolving loan, the loans that cannot change, like a spot loan, whatever you get, like automobile, you want to buy automobile or mobile or home, or personal loans, you get once and you are paying within the specified period of time. But when it's a revolving loan, it's a credit line. Up to 7 million you can borrow within, let's say, 10 years. And you borrow to the 1 million, the next year you're gonna borrow 2 million, and so on. So it will depend on the need that you need to finance. And it was nowadays the credit card debt became very popular. We can say from individual loans, like 80% of the credit cards, so of the all loans, of the all individual loans, are the credit cards using the Visa, MasterCard. Like everybody is using the credit card. Even Halyk Bank, they created a credit card, which is nowadays 7 million credit cards. So you will be. I can go, for example, as an individual person, based on my pension contribution, I can get this credit card. Like the maximum amount will be the 7 million. So I can use the 7 million within, let's say, if I use all, I have to pay back within 1 year. But there is a credit card which is 7 million tenge, which is issued by bank. And these are the graphics that represents the charge-offs, the return on the credit on the loans. There are another types of loans like farm loans, other banks loans, and non-bank financial institutions like broker margin loans, foreign banks and the sovereign governments and state local governments. They issue bonds in order to borrow through the banks and so on. Basically, there's a formula that you are all familiar with this. We already passed through it. Return on the loan. How do they price it? How do they put the pricing on the loan? They use interest rate. They use different fees. They use the credit risk premium. They use the collateral and other requirements such as compensating balance and reserve requirements. And what was the compensating balance? Let me remind you, compensating balance is the minimum amount of the money that should be kept by the borrower in order to get certain loan. So return is here. So using this formula, and expected return using this formula. So we are already familiar with this formula. This is the kind of pricing to a certain loan. And note that realized and expected return may not be equal all the time. So when we solve some question, we'll understand better. So there is a retail loan, there is a wholesale loan. A retail loan usually a simple accept rejection or accept or reject decision rather than just adjustment to the rate. There's a simple credit rationing. Credit rationing when you do monitoring and screening out the borrower credit worthiness. If the loan is accepted, the customer is sorted out by the loan quality at the end of the day in order to provide, if you're going to provide in the future a certain loan as well to this guy. I mean, you will be knowing whether this borrower is credit worthy or not, and you will try to classify them in accordance with their quality of their payment. And for mortgages, discrimination via the loan to value rather than adjustment rates. So we are trying to always attach to a certain collateral, to a certain value of the asset they purchase. This is how it works, not with the rating system. And when it comes to the wholesale loan, in here we use both quantity and the pricing adjustments. Like we go into more detailed analysis. We don't just give acceptance and rejection. We do more analysis, we do more financial statement analysis, which techniques we use like Altman Z-score and Probit and Logit techniques can be applied and so on in order to measure the credit riskiness of the certain, if there's a wholesale loan. If it's a retail loan, it's just simple to require some specific official document in order to provide the loan. Availability and the quality of the cost information are critical factors in credit risk assessment, so facilitated by technology and information. Qualitative models like borrower-specific factors are concerned as well as a market or systematic factors. So we're gonna discuss this like borrower-specific risk, market-specific factors, like those that include business cycle and interest rate levels. And specific factors, they include the reputation, leverage, volatility of earnings, covenants, and collateral. So these factors should not be ignored in order to measure the credit riskiness of the potential borrower. We start with the first credit scoring model, linear probability model. It's statistically unsound since the value of obtained are not probabilities at all in here, as the name suggests, and since the superior statistical techniques are readily available. So there is a little justification for employing this model. So it has some pitfall on it. And due to this pitfallness, due to this weakness, it is advised to use a logit model. It's more or less same with this, but with difference that they provide using probability model transformation, which is logistic function. They go like from 0 to 1 interval. They put like from 0 to 1 interval. The higher the number you get it here, the more it underlines the more probability that this guy is going to be defaulted. There is another alternatives that includes probit and other variants with nonlinear indicator function. So we'll go through this all, but the most popular is the logit one. So we'll go with the example of logit and Altman Z-score. So the quality of the credit scoring model has been improved by providing positive impacts on controlling write-offs and defaults based on some empirical studies. As I told you, there is another one like Altman linear discriminant model. So this is Z-score model. It's actually nowadays it's Altman. It's a scholar who has invented this, who has developed this model, but he has developed for the manufacturing companies, not for the financial institution. But recently, it has been very famous that according with the empirical result that Altman Z-score has been used in financial market as well, in the financial industry. So it became very popular as well. So that made the things more interesting using the Z-score. So in here, using the Z-score, they give the critical value from 1.81 to if I don't remember correct, just it was from 1.81 as the critical value to 2.90. So if the value you estimate in here, for example, for the Z-score for a certain company, you get it less than this, then you reject. Or we can make it like this, high risky. If it's more than 2.90, less risky. Or low risky. Risk in terms of default. And if you are in the between this range, then you're moderate. So when you get the results of Altman Z-score in here, like high risky, then you reject the loan. If you get it between, maybe you will need to do more additional analysis in order to come up with a certain decision. But if you get more than 2.90, you get actually decision accepted. So we will solve questions. At the end of the chapter, there are many questions, we will solve it. And we will understand better how these mathematical instruments are used to do credit risk analysis in order to provide or not to provide the loan, to come up with certain decision. So X1, as you can see, so these numbers are fixed, okay? They are not changing in here, like 1.2. These are the coefficients, okay? That was found by Altman linear discriminant model, and they show here they give some critical value as well. And for X1 they say it's a working capital over the total asset, retained earnings over total asset. X2, X3 is the EBIT or total asset, X4 is the market value of equity over the book value of long-term debt, and X5 is sales over the total assets. So if you get the value, if you calculate everything, and if you get the value less or more than 1.8, then it just underlines actually the probability of default of this guy. Not the probability, but riskiness of this guy, of this potential borrower. However, there are some problems with linear discriminant model. It only considers two extreme cases, default or not default. and weights need to be stationary over the time. It ignores some hard to quantify the factors, including business cycle impact, and database of defaulted loans is not available to a benchmark the model. So there's some weaknesses. So, but this weaknesses doesn't make this model to be ignored, or doesn't make this model not popular, but still this model is used. Most financial scholars in the economy, in the finance industry, and the financial institution itself, and some companies, manufacturer, or it can be other companies, the managers, the top management, they use this Z-score to try to see not the defaultness of the company, but to see how much the company is stable. So they give the proxy for stability of the company, whether it's stable or not. So in World Bank database, some of you already familiar with this. There is a data. It's a database where you can download the data. So there is Z-score is available, okay, but for the banking industry, it's available for the banking industry. So I will go for global financial development database. I'll select any country. Loading. Okay, let me select the Kazakhstan. And series, as you can see, there are many bank concentration. Some ratios are given here, like bank Z-score. Okay, here the model we have it. There's another indicator, it's a competition indicator and so on. But if I select it, let's say the timing, I will select the maximum timing, 25 years, apply changes. So this is for the whole industry. So the World Bank database, the statistician who works in the World Bank database, they computed for us using this formula, using this Z-score formula, Altman Z-score, they computed for the banking industry. So once it appears, I want to see what is the Z-score stability. But in my case, it's for the banking industry based country by country. But it's better when you do the research, for example, when the scholars, they do the research, they do it separately for each bank. If there's like 300 banks, they will do for all 300 banks this Z-score for each year. So this is only can be done for 1 year for one bank. And imagine there are 300 banks, you do for each year and for each bank. Let's say if you have got 20 years and so on. So it doesn't come. Maybe due to my internet connection. Anyway, so it's available here. You can get and see approach for any country which is given here. You can get access on it and try to compare how the country. So when you do this on banking basis, on the country basis, actually it gives you the idea of the banking industry of this country. How's where the country is having the position, is a stable country or not? So as a potential investor, you want to go and invest your money in certain country, it's better for you to check the Z-score as well of the bank on average, whether it's good or not. If it's less than 1.81, that could give you the idea that the banks in here are not really doing well. If something goes wrong, you won't be able to get your money back. Okay, once it comes, I will come back to it. So there is another model, there's another method, which is called term structure methods. So if the risk premium is known, we can infer the probability of default. So risk premium can be computed using the treasury trips or zero coupon corporate bonds. So you can get actually get to know well a bit about the probability of default as well. So term structure may be generalized to loan with any maturity to adjust for changing in default recovery state rates. The loan can be assessed using infer probability from the comparable quality bonds if it's not available. There is another model or another method which is used, which is mortality rate models. It's similar to the process employed by insurance companies to price policies. So the probability of default is estimated from the past data on defaults. So value graded of B default in year over the value graded B outstanding year one. And mortality rate model 2, it's value graded B default year 2 and value graded B outstanding year 2. So we'll come to this and when we get into more examples, so all the models, these are the methods are used to measure the probability of default, or simply to say the credit riskiness of the borrowers. So when we apply into what do you call it, into practice, when you put everything into practice with some questions, we'll understand better what is the logic behind each of the model which are used. So the banks does not, when the financial institution, they do evaluate the corporation, they use these models, but they do not apply it for the individual loans because it's not really logical to do so. It's a time consuming and it doesn't work for the individual. Individual loans are simple and straightforward. You just check necessary documents, which is officially provided for validity, and that's it. And answer some certain questions like, is he a responsible person, or how many children he has? If he has having like 5 or 6 children, does it have an impact or not, and so on. If he's married, if he's alone, like when he's alone, he's more stable maybe, or maybe when he's married, the two incomes are joined and can be support, like the wife can be a guarantor, can give a guarantee that in case he's defaulted, the wife is gonna pay, and so on. The third model, the fifth model is RAROC models. It's risk-adjusted return on capital. It's one of the most widely used models. Like it's 1 year net income on loan over the loan risk. So loan risk estimated from the loan default rates using some duration measurements. So for denominator of RAROC, duration approach used to estimate the loss of value here. In value of the loan, here how we use it. Option models, it's another model which employ the option price methods to evaluate the option to default, used by many other largest banks to monitor the credit riskiness of the potential borrower. So applying the option valuation model, Merton showed value of the risky loan, so he gives this model. Still, again, it shows, and these all models that you should keep. You don't have to memorize these all formulas. You have to know that basic idea behind these all models is either to reject or accept the request from the borrower, from the commercial borrower, not the individual. Okay. So when we apply all these models into the practice, when we apply into the problems when we solved at the end of the book question there, so there are questions that can be solved, then we can understand better how it can be employed in order to reject or approve a certain loan for a certain company. Okay, I'm done for this chapter. So we'll have more calculation, we'll have more practice in this chapter, and it will be more interesting. So before the lecture ends, I would like to take the attendance. Still it's loading. Okay, I will make it for tomorrow. I'll show it to you tomorrow then. Let me take the attendance quickly before we end. If you have any questions, please ask the question. Rinat?
Yeah, I'm here, Professor.
Okay. Karina?
I'm here.
Hayday,
I'm here.
David,
I'm here.
Anel. Okay, Aziza,
I'm here.
Camila,
Here.
Timirlan,
Yes, I'm here.
Aydana,
I'm here.
İnkar,
I'm here.
Aynur,
I'm here.
Adil,
I'm here.
Diaz, Alin,
I'm here.
okay, Evgenia,
I'm here, Professor.
Baglan,
I'm here.
okay, Anwar, Alina,
I'm here.
Nariman,
I'm here.
Saidat,
Yeah, I'm here, Professor.
Baglan Kleshov,
I'm here.
okay, Sabit,
Present.
Vladislav,
Here, Professor, and Diaz is typing you in comments.
who is typing?
Diaz Hasinov.
Okay, I have some problem with internet. Okay, I'll come back to it. Thank you, Vladislav. Okay, Janelle, Ksenia, Daulet,
I'm here.
Timirlan, he was
I'm here,
here.
Professor.
Zan,
I'm here, Professor.
okay, great. And Diaz was here. Okay, thank you so much. I will see you tomorrow.
Professor, can I ask something?
Yes, of course, I'm here.
Regarding the quiz on Friday, will
Yes.
it be also like bonus for those who wrote badly the midterm too?
You just attended. I will see it, okay?
Mm.
How can I
Okay.
improve? You just attended.
I'm sorry,
Okay,
Professor. I've missed this information maybe in the beginning of the class because I was a little bit late.
Yeah.
There will be a quiz on Friday, right?
Yeah, there will be quiz on Friday. It's on Moodle, announced on Moodle. It's
Okay.
you're responsible for chapter liquidity risk. And this quiz will be third quiz, and I'm gonna select 2 best quizzes out of 3.
Okay. Okay.
That was the thing that I already said, and you can just study on Friday. And
It will be not like a bonus, right? It will be like
it's not a bonus, but it was, I received the recommendation, like advice, if I add it as a bonus for those who performed already good in quizzes, but they wanted to add some bonuses to the exam too. So use this
May I
quiz 3 as a
also-
bonus to quiz 2.
Will it be during the class?
Yeah, it will be during the class hour.
Okay.
and midterm exam will be on 15th, right? On the last day of the class.
Midterm exam is gonna be on 16th, according to the calendar. It's Friday.
Okay. On 16th during the class, right?
I don't know. I have to check the timing. The timing should be given. Just a second. Financial institution management at 9 o'clock, 9 a.m. Okay.
16th, 9 a.m., right?
Yeah, Friday.
Okay.
Okay.
Okay, Professor.
Professor, goodbye.
Goodbye. Take
Goodbye.
care.
Thank you, Professor. Have a good day.
You too. You too. Bye. Take care, guys.
Thank you, Professor. Bye. Have a nice day.
Thank you so much. See you.